Welcome, viewers, to the very first and inaugural edition of the M2M podcast, the Manoj and Medury on markets. We will start with a very interesting topic around Forex reserves. Now, some of you may think it is a dry topic. What is there to learn in it? But trust me, the next few minutes we'll walk you through not just the concept, but what are the real implications for your investments as a stock market investor, what you should be doing, not doing, etc. So, without much ado, I will jump into it. Manoj, very warm welcome. Happy New Year to all of yours. Happy Sankranti, Happy Pongal, etc., etc. So let's dive in. So in this particular podcast, we'll cover the importance of forex reserves, especially for India, why they're essential, how fluctuations in these reserves can impact the stock market. So we'll start with the basics. Manoj, what exactly are forex reserves?
Okay. So Ram, you have purse in your pocket, right? Okay.
Yes.
Yeah. Why do you need that purse? Or for that matter, your phone these days? Now purse is irrelevant. Now phones have become irrelevant. Okay. So essentially, whatever you need to pay for that, right? We know that there are no free lunches, more so in an economy. So you need forex reserves to pay for what you want. Okay, and for that, maybe we can go back a little and understand the origin of currency and the origin of forex, so that our viewers get the concept right, and then they'll be able to themselves understand the implications of these changes. So as I said, we need money for our transactions. Whatever we want, we have to pay for it. And every country has its own money. Okay, earlier, going back many years back, gold was the universally acceptable currency. Everybody would trade in gold. So imagine a small village where there is a village fair happening, and all the villagers have to buy whatever they need from that fair. Unfortunately, even those days, Rolls Royce, that is an elephant, has to be bought in that fair only. Now imagine somebody carrying 10 kgs of gold and scouting for different shops buying an elephant. Pretty painful, right? That load is better carried off by the elephant. So let us say just outside this village fair, there's a small hut, and in that, let us say Ram Medury is staying. And Ram Medury is a very respected person in that village. Everybody trusts him, and his word is final word as far as the villagers are concerned. So these guys who trade, somebody carrying 10 kgs, that guy goes to Ram Medury's hut and says, you keep this 10 kgs of gold with you, and I will collect it back whenever I need. But howsoever trustworthy Ram Medury may be, the guy wants to play safe and says, just give me a receipt, saying that you have 10 kgs of gold. Now, Ram Medury, being a very helpful person, he says, why one? I will give you 20 receipts saying that I have half kg of gold. So now the liquidity is injected. The guy deposits 10 kgs of gold and now carries 20 pieces of paper, which are essentially receipts by Ram Medury, saying that anybody who produces this check, I will give you half a kg of gold. Now, whatever this guy is buying in the fair, all he has to do is, Ram, everybody says, who doesn't know Ram? Ram is Ram. So here is a chit of Ram. So he says, Ram's chit is gold. No problem at all. So everybody is happy to accept that chit as payment for whatever the person is selling. And this is the origin of currency. And here, Ram Medury is the central bank of that particular village. Ram Medury is the custodian of gold who is creating currency. Now let us switch to another village where there's another village fair happening, and there's a hut outside the fair. And here another central banker, Manoj Trivedi, is there, but who is not so straightforward guy. In fact, he's a kinky guy. And he says, if you give me 10 kilos of gold, I will give you receipt for 20 kgs. He will give you double the receipt. So he's not being fair. But then the entire village knows this habit of Manoj. So if you buy something worth 1 kg of gold, and if you give him a receipt saying that here is 1 kg of gold receipt by Manoj, the shopkeeper will immediately say, you know what, I need 2 kgs of receipt. because he knows that if he produces 2 kgs of receipt, he'll get 1 kg of gold. Insofar as that particular village economy is concerned, it is working perfectly fine, because everybody knows 2 kgs of receipt is equal to 1 kg of physical gold. Whereas in the village where Ram Medury is the central banker, 1 kg of gold is equal to 1 kg of gold of receipt. Now, if a person from Manoj's village goes to Ram's village and offers Manoj's receipt, the villagers will not accept. They know that, first of all, they don't know who Manoj is. They want receipt of Ram. And when the guy goes to Ram and says, look, I'm giving you my receipts, give me receipts of Ram, knows that this is not worth it. So automatically an exchange rate is fixed where 2 receipts of Manoj will become 1 receipt of Ram. This is because both the villages are completely independent and have their own systems and beliefs. But there is a need for a link so that the 2 villagers can also trade amongst themselves. And that is how the foreign currency comes into picture. For the villagers of Ram, Manoj is a foreign currency. For the villagers of Manoj, Ram is a foreign currency. Okay, when you are taking a receipt, but you need your domestic currency only. In Ram's village, only Ram's receipt is accepted. In Manoj's village, only Manoj's receipt is accepted. And that is where we need exchange. So Ram's notes have to be exchanged with Manoj's notes, and that is where foreign exchange rate will come into picture.
Great, Manoj.
So
Great. Yeah, that's a great summary. So, I mean, just to summarize, uh, Forex Reserve is nothing but a kind of a savings account for international transactions. And just like we need to pay for groceries with cash, the company needs it for paying goods and services from other countries. And you very beautifully explained how, taking the example of 2 villages, how the exchange formalities are kind of set up. So we'll not get into complex topics like swaps and derivatives, etc. We'll straight away come to how does it impact the economy, and specifically let's talk about when the reserves rise. Let's take India as the village now, for example, right? What happens, when the reserves rise, and what happens when the reserves dip?
Yeah. So now that we have understood that we need these forex reserves only when we are buying or getting something from outside of India, right? So long as I am self-reliant, whatever I get it from my own country or my village. I don't need another country's currency. But the moment I am trading with some other country, the forex comes into play. And I have to give the currency which is acceptable to the seller. If I am a buyer, I can demand 10 things in terms of quality and all the specifications. But when it comes to payment, it is the seller who will decide what he wants in return for whatever he is parting with, either goods or service. Okay, so because, as I have been repeatedly saying, the dollar is accepted by everybody because the dollar is accepted by everybody. You accept a torn 10 rupee note happily, so long as you know that you can actually give it to somebody else and that somebody will accept it. The moment you feel that the torn rupee is torn beyond repair and nobody will accept it, you will also stop accepting it. So the purpose of having a foreign currency is to pay for what you want from outside the country. And therefore, if you have more of that money, that means your buying power is more. As simple as that. You have lots of money to buy. If your forex reserves are falling or are less, that means your buying power is getting crunched. Now, so your forex reserves, what is sufficient is dependent on what is your requirement of that foreign exchange. What are you consuming from outside of your country? Okay, so typically there is one aspect which is imports. Okay, we import oil, we import gold. Unfortunately, gold is not grown in India. We don't mine it so much, so we import gold. We import a lot of technology and many things for which we need to pay in dollars.
Right.
For that, we need our forex reserves. Now, how do we earn our forex reserves? Exports is one thing. Okay, whatever we sell to outside of India, we earn Forex. Then there are many NRIs who are staying outside of India who frequently send money to their families, etc. So that money comes in. Here again, Ram, we have to take a small detour understanding the concept as to how this exactly works. Just like in our village example, the person has to first exchange the currency. So let us say somebody wants to send money to his or her family in India. It's not that dollars are put in an envelope and you do a FedEx and the money comes in. Every currency transaction has to necessarily go through the Reserve Bank of India. I know many people go on holiday and they keep some dollars in their pocket and they bring it. But that is an insignificant part of the total Forex trade, which is close to $5 trillion a
Manoj,
day.
related to what you said, there's a small joke I want to share. Why do Forex reserves never get lost?
I don't know. You
Because
only tell me the answer.
they always know how to find their way back to the central bank.
Okay. Okay, great. So, I mean, this might look very perplexing to many, but the dollar never leaves the shore of the US. The yen never leaves the Japanese shores. The currency of a country stays in that country only. So how does this actually work? So let us say Infosys has done a project for, say, Citibank, and Citibank has to pay, let's say, $1 million. Now, Citibank will transfer this money to the Federal Reserve. No, I think I'll take a step back. Let's say it's not Citibank. Let's say it's General Motors or some non-banking organization.
Yeah.
So it has an account. Infosys has an account, let's say, with SBI. So the dollars have to get transferred from the bank of this General Motors to the bank of Infosys. That is what is the payment. Now, this money, once it comes to, say, Citibank, which is the banker to General Motors. Now, Citibank has two options. Either it will hold the dollars and then request Citibank New York, Mumbai, to release the rupees to Infosys. Or the money will be transferred to, say, SBI New York, and SBI New York will instruct SBI Mumbai to create those rupees in Infosys account. So the dollars are going to remain in the US, in New York only. The dollars are not going to come back. The dollars are against those dollars, rupees are released. So who is doing this release? This is being done by the central bank. So the central bank, the Reserve Bank of India, takes control. Every bank has an account with the central bank. So whichever bank is having these dollars will deposit it in the central bank, and the central bank against that is releasing the Indian rupee. Now, what does the central bank do with that? It actually goes and invests those dollars in the US itself. That is why we say India is holding so many billions of dollars worth US treasury, or China is holding so much of US, because you don't want to keep that money idle. So you keep it in a safe place.
So,
Okay.
Manoj, the concept is great. And you said Reserve Bank manages this role, right, of a traffic policeman or whatever you call regulator.
It's the custodian. Yes.
Custodian. So, how does the balancing of imports and exports work? In the context of the trade deficit, India always has a trade deficit. So, can you quickly cover that point?
Yes. Yes. So now again, you have to differentiate between a trade deficit and what is called as a current account deficit. A trade deficit is the difference between export of goods and import of goods. Goods only, not services. When you include services, then it becomes a current account deficit. Okay, so given that we are a large importer of services, we should be looking more at the current account deficit and not so much as the trade deficit. Okay, so our exports of goods and services are typically lower than our imports of goods and services, and that is why we have a current account deficit. Now, what does this mean? That means we are buying certain things for which we don't have enough money to pay for. because we've not sold that many things. So there's a gap. So I have taken, let us say, 100 rupees worth goods from you, and I have supplied you 80 rupees worth of goods only. So between you and me, I have to give you 20 rupees. Now, the moment this figure becomes bigger, it is a concern. Will I be able to pay or not? Okay, but in addition to the current account, we also have something called the capital account. And capital account is the inflow and outflow of capital, currency that is coming in as investment, currency that is going out of the country as disinvestment. So we have foreign direct investments and we have foreign institutional investors who pump money into India. Similarly, Indian companies are now investing heavily abroad. Okay, so we now own some of the big companies in the world because our companies have taken over them. So capital flow is happening, and typically, particularly in countries like India, we have more capital inflow coming in than the capital outflow. One technical reason is we have restrictions on capital outflow. So we do not have what is called as fully convertible rupee or full convertibility of rupee. People can't just like that walk in, walk out with capital. There are certain restrictions. So capital outflow is monitored by the RBI. And the way the balance of payment works, just like a balance sheet, again, don't want to get into accounting, the balance of payments position is always balanced. So if we have a current account deficit, we'll invariably have a current account, capital account surplus. Okay.
Got it. Manoj,
so balance, how much money we have to pay, either it is because of capital inflows or because of our exports, that is our Forex reserves. Okay. This money could be the loans that we have taken. We meaning Indian companies or individuals or whosoever. It could be loans, it could be equity, it could be anything. It is money that has come out of India into India. That is our capital inflow. So we have that money to pay for our exports. End of the day, these Forex reserves indicate the confidence that the global economy has on a particular country. So if you have swelling Forex reserves, it is possible that it is attracting a lot of capital into the country, or this country is having a lot of exports. For example, take China. China does a lot of exports. So you see, China will have current account surplus against most countries. Okay, India has a current account surplus with US, but we have a deficit with China. Okay, so it depends on what kind of trade is happening. But end of the day, somebody is supplying to you, having confidence that you will pay back because there are huge amount of Forex reserves that are lying with you. You have the money to pay.
Yeah, almost everybody has a trade deficit with China. So let's come to the impact on stock markets. What does an investor need to be really aware of? See, Forex reserves, when they fall, right, we all know it kind of increases to volatility in the market. However, we have done some analysis, and I will get a chart inserted on that later, that over the last 15 years, the movement of foreign inflows hasn't really impacted the market much to what people seem to commonly think. Market has always gone up in the long run, and when market has fallen, there is no necessary correlation. But still, there's a sentiment involved here. When investors see declining reserves, economic instability. So it's like a crowd leaving a concert when the music suddenly stops, right? So let's talk about that, and what are the global factors here at play? Tariffs that are likely to be introduced with the new Trump administration being inaugurated in the next few hours. What is the impact?
So, see, we have understood now that Forex reserves are an indicator of the payment capability of a country in very, very simple terms, right? Now, so if you are having large Forex reserves, that means you have the capability to buy whatever you want. And if your Forex reserves are thinning or reducing, that means your ability to buy, etc., is reduced. Now, coming to stock market specifically, we all know that the single largest factor that impacts stock markets is liquidity. More money coming into the market, markets will go up. More money pulled out of the market, markets will go down. Irrespective of fundamentals, irrespective of whatever happens, it's a daily trade that impacts the volatility in the market. That is the reason why we have lots of ups and downs on any time frame basis. Okay, but you see that in the long term, the growth is up because of the various fundamental and macro factors. So when we are seeing that the forex reserves are falling, more fundamentally, is it really causing a problem? Is India heading towards any kind of danger? Answer is clearly no. Okay, less than 6 months back, we had $700 billion of forex reserves. Today, we are at about 625 odd. So what we have lost over the last 6 months or so is about 10% of our reserves in 6 months of time. And this is largely because of foreign institutional investors pulling out money. Okay, we all know that forex reserves are falling mainly because the FIIs have been pulling out the money. And again, this has got a lot to do with US economy and perceptions of how the US economy is likely to behave vis-a-vis other countries. So let me take it one step at a time. So what is the expectation of the US economy, and why should a foreign institutional investor want to pull out money from India and say invest in the US? Not necessarily for some very positive news. We've seen inflation constantly rising. Okay, US has not been able to tame inflation. We get some good news in a month, and then again there is some other news where it says that inflation is again raising its head. So even now, inflation in US is expected to remain higher than their comfort level, which essentially translates to higher interest rates. We've had a session earlier where I have explained that interest rates are one of the reasons. Inflation is one of the reasons for interest rates. So if inflation is high, interest rates are high. That means for someone who is investing in the US, the returns are higher if you are investing in US, because the nominal yields have gone up. In real terms, it might not account for much. After knocking off the inflation, the return might be minuscule. Yet, for someone who is in the US, it makes sense to get that extra 0.5, 0.75% staying invested in the US rather than taking the risk of investing outside the US. So a lot of these FIIs follow quant models, and they have allocation strategies. And based on that allocation strategy, you will see that FIIs will invest more in the US because interest rates are likely to remain higher. Unlike the Federal Reserve predicting earlier, particularly after Trump's re-election, and this is what, again, we spoke in one of our conference calls, while the market is perceiving Trump to be pro-India and India will benefit from Trump, etc., Trump's policies are unpredictable. And while he has the single-minded focus that we'll make America great again, whatever policies is talking of in terms of higher tariffs, etc., might not necessarily be good either for US or for the rest of the world. So we'll have to see, wait and watch how these things pan out. But typically, forex reserves are falling because FIIs are pulling out money. FIIs are pulling out money because it is anticipated that interest rates in US are likely to remain higher on account of higher inflation and Trump's policies, which talk of increased tariffs, etc. See, increase in tariff again means inflation. Okay, so, and we have to understand, America is no longer in a position where it can simply dictate terms and the rest of the world will, with folded hands, follow. Okay, so Trump will realize this. Yes, they do have an upper hand. It is the single largest economy. They have lots of negotiating power, etc. But it's not that they'll just do what they want and the rest of the world will follow.
So Manoj, I think if you look at what happened in 2013, there was this so-called taper tantrum when the Fed was trying to tweak the interest rates, right? At that time, India faced a significant fall in the forex reserves, and the investor confidence took a hit, and markets had a downturn. So in the very short term, maybe there is an impact, but from a longer term perspective, long term investing is not that impacted. We've seen with the chart earlier. So I mean, if we just wrap up, right, in terms of the effect on stock markets. So one is the investor sentiment. I'll just recap whatever you just said, and then please free to add some more masala to it. Okay. So investor sentiment एक है, which is a very very short term focused thing. But if somebody is very worried कि what will happen to my portfolio in the next 1 week, they can probably take a hard look at these movements. But if they're in the long haul, then use these dips to actually invest in high quality stocks, because it's like you're getting a periodic sale in the stock in the department store. Go and buy. um, then currency depreciation. India, again, there's another chart which says that the depreciation of Indian currency is much less compared to many other currencies. That also is a chart that I will add up. So there's no need to worry that India is becoming weak because rupee is moving from 83 to 84 to 85. Many other currencies have been even worse. So the other aspect is volatility, foreign investment withdrawals, and if you may want to comment on economic growth, whether there's any correlation with this or not, and on the borrowing cost for a lender, in India, does that have any correlation with forex movement, or it is largely secular and contained within India? And with those two, we can largely, end this illuminating session on forex.
So, see, the rupee depreciation is again linked to the withdrawal of capital by FIIs, because an FII will calculate return in dollar terms. So, the more the rupee depreciates, the return in dollar terms for an FII actually reduces. And that's a vicious circle. FIIs pulling out money will impact rupee, because there's greater demand for dollar, and obviously proportionately higher supply of rupee. So that will weaken the rupee. Weakening of rupee will impact the dollar returns of FIIs. So this is a vicious circle. One thing leads to the other, and this will happen. So fact of the matter is, liquidity impacts markets, and currently with FII withdrawals happening, we are seeing markets getting impacted. And because the amounts are too high, I mean, close to 2 lakh crores of rupees have been withdrawn from the market. So that will have an impact despite the balancing done by the domestic institutional investors. In spite of that, we do see a significant fall in liquidity. Now, the second funda, liquidity chases growth. Okay, we said markets are dependent on liquidity. Currently, liquidity is coming down, and therefore, we are seeing rupee falling, markets falling, etc. But the fact is, liquidity chases growth. And from a future perspective, we have to see where is growth. And for all along, for the last 2-3 years, where we have seen a very bullish Indian stock market, the almost everybody seemed to agree that the growth is in India. What has caused this sudden dip is the relative underperformance of our corporates in the second quarter. So the kind of growth that was expected in Q2 did not materialize, and that probably triggered a greater withdrawal of capital, because had the growth been there, liquidity wouldn't have moved out of India. But because Q2 was below par, we saw money getting pulled out. And now we will start seeing Q3 results. And that is where I think the direction of the markets is going to be defined. If we see Q2 fall being compensated by Q3, if we see above par results, this entire withdrawal of capital will stop and money will start flowing back into India, because there is growth. End of the day, an investor wants returns, and returns will come if there is growth. Now, if we do not record the numbers that are expected of Q3, then this trend is likely to become stronger. We will see more withdrawals and therefore larger impact. But again, whether it is Q2, Q3 or whatsoever, and again, I will have to add here, a lot will depend on budget, because government is single largest player, and government drives capex, government drives the fiscal policy, which impacts taxation. So if we see in this budget reduced taxes or greater capex, both of these will translate into again fuel for growth. And therefore, even if Q3 is not living up to expectations, you will see more money coming in anticipation of higher growth in the coming quarters. And irrespective, even take the worst case scenario where we our Q3 growth is lower, there's not much of a push by government, we still are one of the fastest growing economies, if not the fastest growing economy. And therefore, it is not that India will suddenly become out of favor. Valuations will correct to some extent, but then after these valuations have corrected, again you start looking for growth. And even with those reduced numbers, we'll still find India an attractive market. And therefore, this outflow of currency will eventually stop. And it will start flowing back. And this has happened time and again. In 2022 September, if you remember, we had the same situation. Forex money started going out, and for 6 to 8 months, the continuous outflow of capital. But then things improved, and then the entire money came back. And as late as early December 2024, we had seen a start of the reversal of money. Suddenly with Trump's announcements, etc., again a lot of uncertainty was created, and again capital started moving back. But I think if Q3 is good, then the Indian markets will again start going up. Q3 not very good, budget is good, again markets will start going up. If these two don't happen, worst case, then we will see a bit of maybe 2 or 3 quarters of little bit of a fall in the markets corrections, and then we'll again go back to the growth cycle. So this is what is the crux of what we can decipher from the Forex reserves going up and down.
I think that's a great way to end this call, this podcast episode. Long-term investor can stay invested in the long-term outlook and not get too much worried about the short-term blips. We didn't talk about the domestic book, how SIP inflows, etc., are keeping the other side of the house strong. We'll definitely do an episode on that, especially now the SIP trend also might change with some of the recent market corrections. That's it from our side, and wish you all a great 2025 further ahead.
Thank you. Bye.